What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about a lot of really insightful and important data points that are not looking great from a recession standpoint. And Jamie Dimon also came out with some very bold statements and comments, which I'm going to break down in this video. And there are a few charts that I think everyone should be looking at right now that are kind of suggesting there is a significant lag with respect to the monetary policy tightening, and the time is just getting started. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate it. All I'm asking in return is that you drop a like and subscribe, and link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the buy and sell alerts, options alerts, members only private videos, trading view charts, the stock reports that we have started posting for all of our members. So links are going to be down below, and we'd love to have you on board. I think I opened up a couple more spots if you're interested in joining. So Jamie Dimon basically came out with this report saying, and I quote, this is the most dangerous time for the world in decades. So what he basically mentioned is that this may be the most dangerous time the world has seen in decades. And that was ahead of the largest U.S. bank by assets, cited among the war in Ukraine, as well as all the geopolitical tensions that are happening right now in the Middle East. And he mentioned that this could have far-reaching impacts on energy prices, food prices, global trade, and geopolitical relationships as well. And he says, beyond the military conflicts, Dimon cited the burgeoning national debt and the largest peacetime fiscal deficits ever, and that he said is raising the risks that inflation and interest rates remain high. Along with higher interest rates, he mentioned the Federal Reserve's efforts to reduce its bond holdings. So in other words, the quantitative tightening measures that they are taking on reduces the liquidity in the system at a time when market making capabilities are increasingly limited by regulations. And Dimon recently has said that he has been warning clients about possibility that interest rates may not only stay elevated, but also could rise significantly from here. He says, while we hope for the best, we prepare the firm for a broad range of outcomes so we can consistently deliver for clients no matter the environment as well. So this right here, again, was the report literally updated today. JP Morgan Chase CEO Jamie Dimon warns that this could be the most dangerous time for the world in decades. Now, this was a very interesting chart from Piper Sandler, right? And what this shows us is the evolution of initial unemployment claims. And what have we talked about unemployment benefits? It is perhaps one of the most leading indicators of a recession, because unemployment benefits, the moment it crosses over 400,000 is when I start to become a little bit more concerning, right? I start to become more concerned with the potential for labor market starting to weaken, and that's going to result in unemployment rates to go higher. But this right here is why, because there is a lag effect with higher interest rates. And this is how many months following the inversion of the yield curve does it take for unemployment benefits, unemployment insurance benefits, or claims basically, to start going up. And this is a chart that's showing you the 2001 recession, the 1979 recession, the 1973 recession, the 1981 recession, the 1990 recession, the 69 recession, and the 07 recession as well. And every single time it has taken us over 12 months after the inversion of the yield curve, and this is where we are today. We are 12 months in, I think close to 12 or 14 months in to the inversion of the yield curve, and we haven't even saw the impact of that on the labor market yet. But there is some consensus, there's at least some expectation that could start increasing, that could start going up. As you can see from this chart that, right now we're still over here, but every single time after that 12-month mark, we have started to see an increase in unemployment benefits. And that has obviously followed up with unemployment rate to also go higher, which obviously leads to a contracting economy, which could lead to potential recessions. Now, there's one more thing that I wanted to mention. This was from Nomura Research, which I think is also really interesting, and it's kind of being under the radar right now. I'm kind of surprised that not a lot of folks are actually talking about this at the moment. And this is the interest coverage ratios for corporations like public companies. And interest coverage ratio is basically calculating the amount of operating income these companies have, and can they actually pay the interest expense on the level of debt that these companies carry, right? So it's not the debt, it's the interest on that debt. Can they cover that, right? That's why it's called interest coverage, because we want to know, can these companies actually cover the interest expense on the debt that they have? And interest coverage to come under continued pressure with restrictive rates and hedges rolling off. So this year, interest coverage has held up relatively well despite a significant rise in base rates. What they're saying is despite the increase in interest rates, the interest coverage ratios have held up pretty well because of stronger than expected earnings. The estimated share of issuers with a sub 1 interest coverage ratio, so if you are under 1, that means you're not even making enough money to pay interest on your debt, let alone any other liabilities. That sub 1x interest coverage ratio remained in line with historical averages at about 10%. Based on reporting from public issuers, we expect continued deterioration in interest coverage ratios driven by a restrictive rates and slowing earnings growth as well. Despite the fact the market implied recession probabilities have declined recently, leveraged loan issuers are very exposed to a higher for longer scenario. And due to these types of pressures, from higher interest rate expense, especially as rate hedges roll off starting in early 2024. So a lot of these companies take on interest rate hedges, right? And they are going to start rolling off in 2025. Not to mention if rates stay higher for longer, a lot of the lower credit borrowers, right, are holding on to floating rates, right? Because they're very much pegged against the actual market rate. So if that starts going higher, their interest expense is going to be higher in an environment which is an economy which is slowing down, so their earnings are not that high, so those interest coverage ratios could fall under 1. And this is exactly why there are more bankruptcies now. So U.S. corporate bankruptcies pick up speed in September with 62 new filings, and we are seeing the highest bankruptcy. We're on path. Let me just bring this up. We're on a path in 2023 to see highest U.S. corporate bankruptcies in over 13 years. The last time we actually saw that was in 2010. 2010. And right now in 2023, this is going to be the highest corporate bankruptcies since 2010. If you come over to this number, this is what I'm talking about. So far in 2023, we've already seen 516 bankruptcies. And in 2020, it was very comparable, right? So if you take a look at where we were back in 2020, so let me just bring that up here, red, and we're going to put up a line. So this right here is going to be that line. Let me just do that. There we go. So right now we're at 516. If I bring this back as far as it can go, 2010 is what we're comparable to. We're on the path to, again, obviously if you get up to 121 in the fourth quarter, so October, November, December, we still have 2020 sitting at 639. So if you eclipse that number, remainder of this year, we would be comparable to that of 2010. And this is the trend that I want you guys to focus on. Look at where we are in 2023. This number has been on this consistent increase. So this right here is what we have seen for U.S. bankruptcy. It's been consistently going higher and higher every single month from January, February, March. April, we did see a bit of a decline. But then once again, we're back in May, June, July, August, and September, back over 50 and 60 bankruptcies per month, right? That's a pretty big deal. A lot of them are coming from consumer discretionary, healthcare, industrials, financials. A lot of these are, companies that are filing for these bankruptcies because if they're a lower credit borrower, which is what they mentioned at Goldman Sachs, companies with investment grade credit ratings have been more insulated from rising borrowing costs because they largely locked in low interest rates because of the higher credit ratings. However, companies with lower credit ratings that were forced to rely on loans with floating interest rates are looking increasingly vulnerable. And a team at Goldman Sachs warned earlier this week that nearly 50% of all publicly traded companies in the U.S. are unprofitable, leaving them particularly vulnerable to rising costs as well. So it all comes down to this man, Jerome Powell, who's walking a very fine line. Okay, on one hand, you've got the possibility of a recession. On the other hand, you've got the possibility of stagflation or potentially even high levels of inflation. So he's walking a very fine line because he wants to prevent doing too much or doing too little, right? He wants to be in the middle. So raising interest rates too much could lead to a recession, which in my book, I think the lag effects and the U.S. corporate debt, not to mention treasury, the government debt, right? And not to mention the interest rates and the floating rates and the interest coverage ratios that are on the decline. It's possible, like as I've mentioned before, that the economy may start contracting here very soon. Unemployment rate starts to push higher. We'll find out very soon. But if he raises too little, right, then that leads to potential stagflation. Inflation stays a little bit more elevated, more persistent, may even start accelerating back higher. So that's the dilemma. That's the fine line that they're walking at the moment. And they are praying, I kid you not, Jerome Powell and the FOMC, they are most likely hoping that CPI needs to come down to 2% before unemployment starts to take off. Because so far, the reason why they have been on such a aggressive interest rate hike policy so far in the last 12 months, 16 months, we've been able to go up 525 basis points. The reason for that is because the economy and the labor market has paved the way for the Fed to get up there. If we had a recession in 2023, right? If we had a recession in 2022 or unemployment was already higher, they would have had to make a choice whether to support the economy or continue on their fight to bring inflation down. But the fact that the economy continues to be strong and we haven't seen a recession yet is the reason why they're hoping that CPI comes down to 2% to their target before unemployment takes off. Because if they both come up, if both CPI and unemployment is above their target, then we are truly in a very bad situation. Because then the Federal Reserve will not know what to do. To raise rates, to cut rates, it'll be a dilemma. And in that scenario, I think it's going to be a bit of a tough time. And that's exactly what I want you guys to prepare for. This is the worst case scenario. Once you prepare for this, you are good, right? Once you understand how you're going to position yourself if we get into a situation where CPI does not come down to 2%, if it stays elevated, if shelter prices don't come down, if they're stubborn to stay higher and unemployment starts taking off, then we need to be prepared for that scenario. Now, both of those things may not happen at the same time for long because, if unemployment starts to go up, people are just inherently going to be spending less. And as a result, inflation can eventually come down. I mean, inflation does come down during times of recession because people just don't spend as much. So they both can't exist at the same time for very long. But of course, in the beginning, they can. So that's the whole idea behind this, is to keep some of these, some of these things on watch because the trends are very clear. I mean, we're, another 120 or more bankruptcies in the 3 months in 2023, and we're going to be looking at a year which is very much comparable to the last 13 years ago. So that's really where we are. So let me know your thoughts down in the comment section below, and what do you think about the markets and the economy right now? This is a little bit more of a macro update, but as always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below, and as always, happy investing. I'll see you all in the next video.